Hello, everybody. Welcome again. Today we talk about Nubank, NU, the rapidly growing South American fintech, which operates in Brazil, Mexico, and Colombia, and soon to be the USA. Now, Nubank has been a portfolio holding of us, and we've held it for a couple of years. And it, in the first half of this year, experienced a significant fall in market value. It went down 30-40% at one stage from mid-16s down to the 11s. And we undertook a deep dive back in just after Q1. We published that on YouTube and on Substack. We decided that we will continue to hold. We thought that the reaction was overdone. People were expecting credit losses to be ballooning and that the credit cycle was beginning. We concluded that it was more of a seasonal phenomena, and we were vindicated. And before Q2, we further analyzed the company and came to the view that the market narrative was significantly pessimistic, and we developed some preempting criteria based on Brazilian macro factors like employment. The market, I think, was paying too much attention to the inflation rate and Selic rate being the Brazilian central bank rate in anticipation of a consumer slowdown and credit deterioration. We decided through our work that the more important leading indicator is employment. And employment levels are strong in Brazil, and there's various reasons for that. Brazil is a very low-cost labor economy, and we're seeing the uptake of labor in that economy is very strong. And we have had high interest rates as a response by the central bank to higher inflation. But this hasn't really impacted employment levels to date. And people don't default on their loans when they've got jobs. A couple of percent in interest rates on their credit cards won't make that much of a difference. So we decided that the employment levels are much more important. And pre-Q2, we saw and into the upcoming presidential election in Brazil, we've had the Desenrola and other programs designed to help voters, and that's kept the economy strong for now. So this presentation, we're talking about Q2 and what we saw as the real story in Nu. So what we saw in the results was very strong. First $1 billion net profit for Nu for the quarter. And we also saw an encouraging fall in the 15 to 90-day non-performing loans, NPLs, which fell from 5% in Q1 to 4.8%. So very encouraging. But that simply reinforces our thesis that the Q1 drop rise in NPLs was simply a seasonal factor. You may recall we said that in Q1 people have probably expended themselves in Q4, Christmas and holiday season. What we've got is a bit of a catch-up period where people are falling behind on their credit cards in Q1, which we saw as non-performing loans going up to 5% of the total book. But in Q2, we saw that had fallen back down to 4.8%. So very consistent with past periods. and that gave the market quite a bit of comfort. However, it's not plain sailing yet. What we did see also was that the 90 plus days NPL rose from 6.5% to 6.9% of the total book. So we may recall that Nu's credit card and consumer loan portfolio has been rising very rapidly over the last year or two. And it's the management's strategy of going a little bit up the risk curve, so taking on a bit more risk on the basis that they will receive more risk-adjusted returns into the future. So Nu's management is purposely lending to riskier people, and expecting higher credit losses, but knowing and expecting through their proprietary data and insight to these consumers, which we'll get to, that the credit losses will be lower than the ultimate profit. So it's a conscious decision to increase the risk levels in the book, knowing fully well there'll be higher credit losses, but even more profits. So that's very important to keep in mind for Nu. So we've had a 90 plus day NPL number, which went up from 6.5% to 6.9%. So summary, Nubank may now be operating with higher structurally NPL levels because it's deliberately chosen to make more risk, to take more risk. And I suppose the question for another day, is it pricing this risk correctly? So we need to not judge Nu by the NPLs alone. We need to look at post-credit loss earnings. That's the real story. What return is Nubank generating for every unit of credit risk deliberately assumed? Now, if you're still with me, it's a bit complicated. This quarter, we saw rapid lending growth, which temporarily flattened earnings before the losses arrived. So I'll just explain what that meant. So what happens with Nu and other banks is that they are forced by accounting standards to provide for credit losses upfront when they make a loan or a credit card receivable. So if somebody is approved $1,000 in credit and the average delinquency on that type of customer is, let's say, 5%, the bank is compelled to recognize upfront $5 or $50 of that $1,000 as a loss. So it's not recognized as revenue. $950 is revenue. So that's what's happening with you. They are providing for these losses upfront, and in my opinion, quite conservatively. So what we've got is, if you look at the expected credit loss numbers in the balance sheet, Nu has roughly 6.6 billion of those. So 6.6 billion of expected credit losses against its book. And just to put some perspective onto that, the credit losses which have been provided for are more than 2.5 times the 90-day plus NPLs, which should be conservative. And I'll explain why Nu has a number of different levers at its disposal. It provides for banking, for bad loans, but it's actually got very sophisticated data collection mechanisms to help it analyze the risk it is taking. NuFormer is Nubank's AI platform. It has, Nu has invested in its own fleet of GPU infrastructure and has developed a very sophisticated financing AI model that it owns. It's not dependent on any, Anthropics or OpenAI for its frontier models. It actually has its own sovereignty, its own data center, its own GPUs, and has no risk of its data being leaked or stolen or looked at by competitors or potential competitors. So New is an AI native or increasingly AI native organization, and it's using this on many fronts in its business. It has, as a customer base, New has now almost 60% of every Brazilian adult. 60% of every Brazilian adult. And 60% of those use Nubank as their primary banking relationship. Now, to understand what a primary banking relationship is, it means that people are now using Nubank not just for credit cards, but they're using it as a deposit relationship where they are receiving their regular paycheck or pay from their job, and they also use it to maybe take out an insurance policy. And New is offering all these different products to customers, and the older cohorts, maybe 10 years old, that have begun with Nubank quite a while ago, are really producing a lot of income on average for the bank with very low service costs. So New has tons and tons of data per customer and is able to slice and dice that data with AI at speed, and is able to dynamically manage credit limits for these customers and know very quickly if something is going to go wrong. Now, the nice thing about New is that it's a short duration credit provider. Unlike banks which offer home loans, for example, long duration loans, it's, in my mind, I think it's much less exposed to the credit cycle because it can turn on a dime. So it has all this information at call using its AI. It's got short duration credit exposure so that if New senses that customers are unlikely to pay off their credit cards or default, they will start noticing that through other data, like not receiving paychecks, for example, in their deposit accounts. And so, provided New moves quickly on this data, which is logical that it would, but we still need to see it in a tough environment. I think the short duration credit model is to its advantage. And so the market is not giving New the benefit of the doubt, hasn't seen a severe credit cycle. But I think the way I'm thinking about this stock is that it's actually much more insulated than others should such a cycle occur. So I'm getting a lot more comfortable about New moving up the credit risk curve without destroying returns. It's underwriting very intelligently, and it's able to quickly manage higher risk cohorts. And talking about cohorts, New is also now focusing on what they have recognized is a lesser serviced premium relationship with the more affluent customers and also small businesses. As we know, as I said before, New can count as its customers 60% of the Brazilian population, and a lot of these people run small businesses. And what we're seeing is an expansion of new services to small businesses, which again is part of the flywheel, more data, uh, more products, and more profit. So I think I'm starting to become a lot more convinced about new as an investment. I did have a lot of reservations, took a position as a fast growing fintech, but now becoming convinced that this is going to be a great story. And it looks like their Brazilian experience is going to be extended into Mexico. Apparently, Mexico is showing the same levels of success as Brazil did, but much earlier, and even so in Colombia. But as I said before, employment remains the key macro variable that we need to keep our mind on. And so we look at Brazilian employment levels as the leading indicator, probably monthly. Don't wait for quarterly earnings releases, so that really that's what I think you should be focusing on. So just to summarize, Q2 has strengthened our thesis, but we've also changed a little bit what we need to watch. So while we, as I said, continue to watch employment levels, we will be looking at uh, non-performing loans very, very closely. I don't think we're out of the woods yet. New needs to prove itself over time, but as time goes on, I think the thesis is being confirmed. So anyway, let me know what you think. If you have any comments in the comment section, subscribe if you enjoyed this, and I look forward to further updates. Okay, thank you.